I'm Brad Avery. I'm a staff reporter with BevNet, and you are in breakout session investment insight pre-market cleanup. So what we're going to do is I'm going to introduce our panelists, and they're going to each take you through different elements of what you need to do to get your company ready for investment, to seek out investment. Our first is we have Brian Goldberg. He is the co-founder and managing director of the Capstream Group. He is also a longtime CFO in the consumer products space and has held positions at brands including Sweet Leaf Tea, Badlands Power Fuels, and Amplify Snack Brands. He is also an advisor and investor to brands such as High Brew Coffee, Pet Plate, and Waterloo Sparkling Water. Our next speaker is Arthur Gallego. He is a marketer and the principal of his marketing consulting firm, Gallego & Company, and since 2004, he has helmed corporate communications for Vita Coco and has worked with startup brands including LifeAid, HealthAid, Ugly, Olipop, Nut Pods, Bulletproof, and Kyla Hard Kombucha now. And then we also have Robert Brown. He is the co-founder and managing director of Encore Consumer Capital and is the chairman of Encore's portfolio companies, Ancient Harvest and Tenderbelly, and the director of Butter London, Navitas Organics, and Supergoop. Prior to Encore, Robert began his career at Swander Pace & Company, where he became a principal and would later serve as a director of Swander Pace Capital. Without further ado, I'll kick it off to let you go through your insights.
Hey guys, Brian Goldberg. Like you said, I'm kind of a long-time executive, mostly in the CFO, COO role, board member, advisory boards, investor, et cetera, in high-growth CPG companies. I've done over, I'd say, $3 billion, maybe pushing $4 billion in transactions on the buy side and the sell side. Ranging from financings, IPOs, debt financings, equity financings, buy-side M&A, sell-side M&A, et cetera. Starting out really with Sweet Leaf Tea. I was CFO, COO there. We did a bunch of financings. We acquired a business. We sold that business to Nestle in 2011. Most recently, in 2014, myself and another guy with private equity firm acquired Skinny Pop Popcorn from the founders, which we then took public. We did a few more acquisitions. We created a holding company, Amplify Snack Brands, and we sold that business to Hershey in early last year. Also was involved in Deep Eddy Vodka, was on the advisory board there. We had a nice run there. We sold that business in 2015. Now on the board of Waterloo Sparkling Water. So a lot of Austin brands where I'm located. So yeah, had a pretty good run. Lot of financings and transactions over the years. So what I did here, I just jotted down 15 or so kind of pre-market cleanup considerations, stuff that I typically see come up over and over again. So I'll just go ahead and just read these real quick, and then I'll pass it on, and then we'll go from there and answer questions. So some of the considerations I had, and bear in mind, I've done lots of kind of early stage stuff, mid stage growth equity, all the way up through IPOs and selling to large strategics for almost multi-billion-dollar sales. So there's definitely a big difference between raising money from, say, Fidelity or selling your business to Hershey compared to raising money from like your mother or your nephew and all that. So I kind of threw all these together, although some are not really applicable to. They're applicable to one side, not the other side. But some common themes. So first off, it's really make sure your business is really ready for prime time. A lot of companies think they're ready to raise capital, and they're really not. So you want to make sure your story is compelling. You have the ability to achieve scale. Obviously, you don't have scale today, but you have that ability to achieve scale. You have some customer traction. That's generally pretty important for investors, and you have really good intellectual property. The later you are in your life cycle, the more important I think intellectual property becomes, particularly when you're selling to a Hershey or a Mondelez or Coke or Pepsi. That becomes more important, maybe less so in the early years. You want to be able to tell a good qualitative story that you could back up with quantitative support. So, in the early years, you want to show that you are gaining distribution, who's your distribution with, you have good in-store velocities. If you're more of a DTC play, you have really good metrics there that you can show investors. Most investors tend to be financial, particularly the later you are in your life cycle. So showing quantitative data to support your qualitative metrics, I feel like is really important. Next one is your quality of revenue and earnings is very important. You want to be able to present channel mix, customer mix, product mix in the best light possible. In my opinion, you want to minimize private label revenue as much as possible. A lot of times you see, companies will accept private label business really just to generate cash flow, and I think you want to keep that to a minimum. I think it's acceptable at some level, but you don't want that to be a bigger part of your business. You want to be able to explain any material year-over-year growth or declines at a customer and product level. I've seen a lot of companies that really don't have good explanations for that, and that tends to be pretty scary when you're on the investment side. You want to be able to show future white space, so whether that's distribution, new distribution opportunities, retail or distributors, future cost reduction opportunities, a path to profitability is important. I think that's becoming more important these days than it used to be, and having an innovation pipeline is also important. You want to be able to understand your competition, both strengths and weaknesses, and how you differentiate. And I don't think you need to bash your competition. Sometimes from an investor perspective, that doesn't look great. So I think showing some respect in what they do well and how you differentiate is pretty important. I talked about intellectual property. That's you want that to be as clean as possible. Trademarks and patents, if that makes any sense for the business, both U.S. and international. In a lot of the sales sold a business to Hershey, sold a business to Nestle. Both times, we were talking to other strategic investors, and that tends to be a massive focus area from a diligence perspective. It's less of an issue when you're earlier in your life cycle, but you want to make sure that is really clean the bigger the company gets. Consider having a financial audit or at least a financial review by an outside audit firm. Sometimes you don't see that for early stage companies. I think it's generally worth the investment, particularly when you're looking at institutional investors. Another consideration is what team members you're going to loop into the process. Sometimes the broader you go as far as your team, the higher the risk of word leaking out, and which could blow up the transaction really. So you want to be smart about who you loop in and make sure they're really tight on confidentiality. Also, from a team perspective, you want to think about who you want to put in front of the investors. If you don't feel confident that you have people on the team that can present well or are capable, you want to be careful about putting them out there in front of investors. On the other hand, investors like to see a strong team. So the more people they see that are capable, I think the more attractive the investment is. I would say get a sample diligence list from your lawyers or accountants, and maybe think about populating a data room early in the process rather than wait for requests to come in. Have ready access to material contracts. That's going to be a big focus area in diligence. Be able to explain the corporate entity structure and your cap table. A lot of times, especially early on, companies have a hard time explaining kind of who owns the company. So that's really important. That can be problematic when that's not tight. And just have good advisors, third-party advisors, around lawyers, accountants, investment bankers, if that makes sense. So anyway, that's kind of a short list of some considerations that I've seen over the years.
Very short and tight. Yeah, get it done tomorrow, right? My name is Arthur Gallego. I work in marketing communications and have a consulting business based in Southern California. I'm proud that a couple of my clients have been winners today. So the Olipop folks have won a couple of awards, and Person of the Year, Human Being of the Year, Badass of the Year, Dinah Trout there, and Life Aid's also a client that won today. I started my career in communications, and it's quickly evolved into a lot of startup CMO work for brands because of the many hats I've been able to wear, which is particularly effective in a small setting. You know, when you're working with a limited budget and you need somebody that can wear a lot of hats, that's typically why I'm brought into companies. I work both directly with the brands, most often reporting to the CEOs or the top management. Sometimes I work with private equity partners. I think what differentiates what I do from a lot of other marketing consultants is the ability to kind of see something bigger, see something different, figure out how to poke the bear a little bit. And I think that I try to break the pattern every time I do something, because a lot of the marketing models now, whether it's advertising or traditional PR or even investor relations, is kind of broken in my opinion. So I wanted to put together a list that I thought would be helpful to anyone that was starting their business in the last few years, ramping up to get pretty for private equity, and give an honest list of some of the things that you should at least consider in regard to your product or your brand. So the first is you have to ask yourself if you've really created a brand that's going to resonate across a number of categories. The first, I think, is ritualistic use. Have you created something that people want to use again and again and again, or drink daily, or use in multiple ways in their lives? I think a product that people feel is too special, or maybe they enjoy it once a week, that's not going to set you up to have a great brand. There has to also be, tied to the ritualism, level of familiarity and comfort with the product. Even if it's something breakout and new, it still has to feel connective. And so I cite Olipop as an example because they have a better-for-you digestive tonic in the guise of a sweet, delicious soda. The taste experience is totally familiar and then leads you into an educational experience about wellness. Popular culture, so I'm going to flag my longtime troublemaker, Jeff Rubenstein, in the front row. He and I have done many marketing campaigns together over the years, embedded in popular culture. We worked on the Rihanna ad campaign for Vita Coco, 2 of those. We worked on that celebrity investment together with Madonna. I think pop culture is for sure changing. I was talking to somebody recently that said that anyone who read Vanity Fair couldn't care less about what was happening with the Kennedys, but they absolutely cared what was happening with the Kardashians. Mm-hmm. So I think that you have to find your space in popular culture as well, whether that's on social media, whether that's through the entertainment and film platforms that are, in our pop culture space today, whether it's through music. Music is always very connective. The product should have some level of functionality. That's increasingly vague, as all of us are terrified of getting sued. But whether it is nutrients added or natural, whether it is an emotion connection that provides the functionality, whether it is a digestive aid, there has to be some kind of function to the product that you're selling. And then, of course, lastly, tied to that is just you need to have a product that's somehow tied to a current trend or an ingredient trend that's happening in the market. I think what happens in the media is we tend to declare something a superfood very quickly, and then we run it into the ground until it's no longer superfood and it's like last year's trend. So it's important that you find something that has some legs and has some evergreen, but is still buzzy. The next checklist item for you is, have you actually tested your brand's equity within the marketing sphere? I think a lot of brands assume because they're selling well that they don't need to actually market. I hear this all the time. We're selling well, why should we put marketing? Why should we do field marketing? We're selling well, why should we advertise? If you don't test any of those things, you'll actually never fully understand what the connective ability of your brand is in a marketing sphere. There are some brands that have gotten by forever on great word of mouth. Those are very rare. There's a reason that those brands are so iconic. But most brands have to test the elasticity of their brand connection through field marketing, product sampling, concert sponsorships. There's got to be something in there before you can go up to private equity and tell them we've got a winner here. You've got to know something about that. Tied to that, I think it's important that a young brand, has analyzed why it's successful. I work with so many startups. Most of them tell me, we're doing great, people love it, we know it because of the sales, and there's nothing past that. And in an age of Amazon, that doesn't mean much. So, because somebody might just be buying something on Amazon, your brand, based on an algorithm or the pure convenience of it, or they might be price shopping, it doesn't necessarily mean that they love your brand. So you have to understand that, but you have to dig in deep as to why you're successful, and that might be research, which can be very expensive. It might be smaller focus groups. It might be even working with an outside analytics firm to just kind of aggregate the data and come to your own conclusions, but that's critical. The next one, you have to be honest with yourself and figure out how differentiated your product actually is on the shelf or online. I was walking down an aisle at Whole Foods with a friend of mine who's an analyst, and she said, all this shit looks the same to me. And, there's only a finite number of colors you can use. Certainly not everyone can afford a custom packaging shape like a Calafia, but you have to find ways to make your product stand out that might break rhythm with traditional branding. And I've seen that a lot recently where, the hierarchy of branding that we might normally use with, product name, product flavor, logo, or whatever that stack is beginning to change dramatically with a lot of the new products I see. It makes for a strange makeup on the shelf because if you go traditional CPG, everything's supposed to look kind of the same and maybe the color scheme is changing. But even at Health Aid, they're totally revisiting their packaging in a way that's eye-catching for every product, collectively or individually. And that's critical if you're going to go after private equity. The next thing on the checklist is less pleasant. It's about your leadership. And I think that you have to find out if you've got a leader that's ready to take on that kind of money and that kind of responsibility and the optics of that. We look at people like Adam Newman and other high-profile CEOs that have taken a fall because they weren't really ready for, I think, that kind of accountability, or they were too busy being showmen to run a company properly. I think that you have to analyze your own leader and figure out if they're, a bit of a loose cannon. You've got to figure out a way to market around them or position around them. Or as Brian said earlier, are you finding the best person to talk about the company or the brand on the team? The CEO's still there, but you've already acknowledged this guy might not be perfect for a roadshow. It's critical. And then the last is you really have to understand where your narrative is, where it lies, where the truth of that is. Everyone seems to think that saying our product's natural, better for you, and made from quality ingredients is a narrative. That is not a narrative. That is a checklist that is basically the price of entry to doing business with a better for you product. It's just complete BS and nobody cares about it. Analysts tell me this, the media tells me this, nobody cares. You have to find a way to, if you don't have an authentic narrative as to how the company was founded or the mission for it, and also on that list of tired is, I couldn't find what I wanted on the market. That's like right up there on the list of tired narratives. You can find ways to engineer narrative later and progressively along the way with your brand. So again, I'm going to cite Dinah as an example. Her narrative keeps evolving as the CEO, and with that, the brands. So, starting as a scrappy entrepreneur, and then talking about motherhood, and then talking about being a defender of competition in the category, her narrative continues to evolve. And I think that if you believe as an entrepreneur that you don't have the perfect narrative initially when you launch, hold back. Just emphasize the product for a little while and wait on that. Shark Tank has made us believe that everyone is supposed to be a rock star entrepreneur. That is not the case. Not every personality is suited or has the mettle or the nerves to be that kind of an entrepreneur in the public eye. So you have to assess that very honestly, internally, including with the CEO. So hopefully that's somewhat of a checklist for you guys as you get together. And I'll hand it over to my buddy
Easy
Robert.
job. There's not much left. My name is Robert Brown with Encore Consumer Capital. We're a food and beverage focused private equity firm located up in San Francisco. Have about a 20-year track record investing in the industry. We've raised a little over $600 million over a period of time and invested in about 50 companies between my partner, Scott Sellers, and myself. Typically, we're getting involved, and this lens is important for the people in the room, companies that are at least 10 million in sales on up through about 100. So we are not VC. We have a different set of expectations that may or may not be appropriate for everybody in the room, but we expect that you have a business model and you have something that's ready to replicate and scale. So just keep that in mind. It doesn't mean that things that I say are wrong, but they may be wrong for you. So I think that's important as you digest some of the things that I have to say here. I think for us as a firm, and welcome all of you to come to the next panel as well, we'll be talking about some of these things in more detail. There are a ton of great options for private equity investment, and I would encourage everybody to just focus on the people. Matt Thomas, I got the tail end of what Matt had to say. He had nice things to say about his investors, and it's because he went through a very thoughtful search about who to work with and what he was looking for. At your stage, valuation should not be the most important thing. That's a self-serving comment, but you're going to be living with people through good and a lot of bad, probably more bad than good, and the people really, really matter. So there's no better investment of your time to get to know a lot of the people running around here and elsewhere to help you think through what's important to you. My list is much shorter, and then we can get to questions and some interaction. What really matters to us is that when you come and meet with us, or more often than not, us come and meet with you, we want you to know your numbers. We want you to be in a situation where even if you're an early stage company, you can't be unfamiliar with your structural economics. You got to have a vision of how it all hangs together. If you don't, that's a red flag. We are, as creative as we can be in terms of understanding your vision and embracing your vision, but it really does come back to do the numbers work. And cash flow apparently is back in vogue now. It was never out of vogue for us, but if you don't start from a place of strong structural economics and understanding your KPIs, I think you're gonna have a hard time raising capital from people who can help you, and you're gonna have a hard time figuring out how to make your business better. So that command of your business is really important. We also really believe in focus and scale. When we see a brand that very early on in its life starts to enter into multiple categories, it's a red flag. When we see a brand that very early on, before really owning a geography or a customer, starts looking for more, that's also a red flag. You really win before you expand. Coming to present to investors and showing them that you know how to win, even if it's a very small part of the world, we're going to help you understand how replicable that is. Can that, is that something that can be taken to new markets, new geographies, new customers, and rolled out? So really, really focus yourself in your day-to-day activities on how do you bring that focus and scale. We get concerned when we see people who are buying business early on. There is really no way to promote yourself into a successful position when it starts with price. There are so many levers that you can use now through sampling, through demonstrations, through developing your business online, partnering with other companies, getting people to try your product without either give it to them, that's fine, or sell it at full price, but give them a good reason to buy it. You can't get yourself out of a gross margin hole in this business. And that's something that investors like us are really going to be looking for. And I think that's especially important for the direct-to-consumer companies here. We are seeing businesses come to sort of older school private equity sources, people who really understand brick and mortar earlier and earlier, because cost of customer acquisition is absolutely through the roof online, and brick and mortar looks better. Well, guess what? If you launch a business with 40% gross margins direct to consumer and you're only selling it for half that price to the retail trade as a wholesale, in a wholesale transaction, you're not going to make any money. Your structural economics, again, back to my first point, they've got to be there. Going hand in hand with that, have your supply chain and major cost elements at least in full view. They may not be totally in control based on where your stage is, but the very first beverage deal that we did was an institutional company. They were selling shelf-stable juice concentrates to hospitals and nursing homes and so on. And during our due diligence, the orange juice concentrate market just went through the roof. It literally increased like 50%. And if this company had simply put hedging contracts in place, it would have been no issue. And it's not sophisticated. It's not hard to do that. But as a result of that run-up, we had to make an adjustment in the price in the deal. It's something we don't do very often, but it cost them a lot of money. And really thinking through, what is the downside? How can I protect my business? Entrepreneurs don't often think that way, and I don't blame you. As investors, we have to be optimistic by nature, but be realistic in terms of what can happen. Look at the last 20 years of data and see what happens if the costs are here instead of where they are, and what you're benefiting from right now. Really think about the cost element of the business. That's hard to do for an entrepreneur that has so much going on, but you can really get bitten there if you're not careful, and some of those things are so easy to solve if you enter into the right relationships. So that's my punch list.
Fantastic. So we have about 10 minutes for Q&A. Can open up the floor if anyone has questions. If you want to raise hands, I'll pass around the mic.
This question is, I think, for Robert. You mentioned focus and that being just something that's really critical early on for early stage companies. I'm thinking through our company's life cycle and the being in the cold pressed juice space and how that category has seen so much competition and has commoditized and things like that. So for me, my question is how can we take a core competency and diversify, but obviously stay focused, both for ourselves, but also so that we don't appear to be too, I guess, not focused.
Right.
So what's it seems like a very fine balance and something that I'm not completely clear on, because there's opportunities, it seems for us to leverage our business in newer functional categories, but at the same time we want to stay focused on what's worked, what's gotten us to where we are, before we jump ship too soon.
Sure. So if you feel like you have a winning product proposition, our philosophy is do more, right? So if I don't, a lot of cold press folks sometimes do their own manufacturing. I don't know if you're doing your own manufacturing or not, but particularly in beverage, if you're trying to leverage a manufacturing asset, you've got to be pumping liquid through it. And Brian made a comment. It sounds like it may not apply to you, but if we're looking at a manufacturing company, we'll actually embrace private label early on, right? Get that throughput going, make sure that you're making money. In your case, what that may mean is, how do I get my minimum runs up with my co-man? In this category, they can kill you, right? You have some shelf life issues, and at the same time you've got minimum runs. So maybe you do something like embrace a Costco earlier on than you might. I mean, we love brands. We have so much fun working with brands, but we're not brand snobs when it comes to a channel like Costco. You look at them, what better place on the planet is there to sell a lot of something, put it in people's mouths basically for free, and find out if it works, because you're standing there talking to them real time. It's an incredible platform. So really pushing yourself to say, okay, where can I do more of what I'm doing well, is the way that we think about it when it comes to spreading yourselves thin. And if you said, you know what, I'm gonna get into cold press salsa, that's where we'd start to be concerned, right? Yeah.
Hey guys, so you each sort of touched on first mover advantage or urgency. Where does the relationship between profitability and spending money to grow fast come into play?
Yeah, I mean, I would say, to Robert's point, if you have the product nailed down, you feel good about what you're selling, and and you have the kind of gross margin, you feel good about gross margin economics and whatnot, then I think it's kind of turn it on, right? Just you go, man. I think going fast these days is important. There's so many other competitors out there and other brands out there. If you don't have that, if you're still kind of like, is this the right product? Is this the right packaging? If you have, kind of spotty distribution, I'd be real careful about spending a lot of marketing dollars at that point.
Gross margin's the key.
Yeah.
If you've got it and you can spend it and you want to spend your cash flow down to zero, you've got some balance sheet capital, that's fine. That can be a great decision. A lot of people will say, well, we know we can be profitable. Well, you're sitting at a 14 gross margin right now. Like you can't. Period. So if you're starting from a great place and you believe that you've cracked the code, that's what capital's for, right? I mean, it's for going in there and saying, let's go. We're confident. We know we're going to test and learn, but make sure that you have the ability to pull that back. And, especially if you read the venture daily rags and so on, the winter is coming. I mean, there's so many trillions of dollars out there. Like, great companies are going to be able to raise money, but being able to survive without outside capital is really, really important. And you want to be able to raise it on your terms, and you want to be able to demonstrate that you can be a good steward of that outside capital.
And if you miss it, if you do it incorrectly, it could kill the company.
Yep.
Right.
Any more questions? Oh. I saw him earlier, so. Over.
You referred to Costco just there. I was going to ask this question anyway. We only sell to Costco right now, and we have done private label for the reasons that you mentioned, to get some money.
Sure.
But I've
They
been
pay
told
quick.
and they pay exactly on time. But I've been told that when it comes to, I'm getting ahead of myself a little bit, when it comes to valuing a company, private equity discounts your sales at Costco. Is that true?
So we can't help ourselves but do that, and it's because of risk, right? I was with a business that doesn't happen to be in the beverage category, with a business on Friday that's a sizable business, $60 or $70 million business. About 60% of their sales are with Costco. But what's important to us as we're looking at that business is, are they succeeding somewhere else, and do we believe that that can be replicable? Costco doesn't want you to get too big, right? Like, you don't love it if they ask that question. So exactly what percentage of your sales do we take up? Like, you don't want to answer that question. And so figuring out how do you break that cycle is important. You're not going to get bank debt on an investment where there's 100% customer concentration. That's very difficult. That's more appropriate for later stage businesses. But we've owned businesses before where they were 50% Costco going in, and we sort of said, oh, we've got to manage this down in terms of percentage in order to have a successful exit. Outgrowing Costco is hard, right? So, we just, about 2 years in, we said, we just want to keep up with Costco. And we were able to do that, and the business doubled over a handful of years, and it didn't hurt us. Strategics don't worry about that. Private equity firms worry about it a lot more than strategics do. And there are still a lot of strategics out there that haven't cracked that code. They don't know how to do business with the club. And I'll never forget when the company I was speaking of that we invested in before was a company called Adele's Sausage. And we sold it to Sara Lee, and the CEO, Sara Lee, said, I'm going to come to Costco with you because I want to hear from Costco, that they're not going to kick you out. And our CEO just knew he'd have him eating from the palm of his hand, because Costco said, listen, if Sara Lee's not doing $2 billion worth of business with us, Costco, in 24 months, you guys have completely done this wrong. So it's a huge opportunity for strategics to buy a company like yours that really understands how to do business with a little bit of a different animal. They still need that.
We had at Skinny Pop, Costco it ended up being about $70 million business for us, like hugely profitable business. And so it was great. Like it basically made Skinny Pop the brand it was. But, especially as a public company, like we worried every single day that phone call was going to come from Costco saying they were doing private label or something else. So there is a balance there. It could make a company, but it can also hurt you too.
I also just don't think that it's the right formula for every single product or every single brand. I think if you're looking for any kind of cool factor, you can go into Costco too soon. And if you go in there with something that's not a differentiation of what you're offering in general, you can actually kill your cool vibe very quickly. And certainly we all want to scale businesses and we want to have a mass consumer, but those early years where, the most influential people are the ones consuming your product are critical. And you've got to build properly, and you have to build a product that has some level of cachet. I mean, I personally know if I can buy a trough of something at Costco for less money, I will not buy that product anywhere else. And you can actually condition a consumer to do that, and it can be detrimental to your brand.
But there's also, I don't think there's any better place to sample as
Agreed.
well.
Agreed.
That's the other side.
That's
Yeah.
sort of Damocles, right?
And there's some great things that you can do strategically at Costco. If you're a small brand and you have a hero product, take your super coffee. You've got one SKU that might be in there on rotation, but if you can do a road show that's got 6 or 8 flavors and they're in there for a weekend, guess what? The consumer is going to fall in love with those flavors, and they can only buy plain 365 days a year in Costco. They got to go somewhere else for the other stuff. And that's a strategy we've used in numerous companies so that you get the trial going in the club, but in order to get the variety, you got to go somewhere else.
All right, so really only have time for like one more question. Okay, I saw.
So, question for Arthur. Yeah, I know. Make you work for it. So you mentioned like marketing campaigns that really connect. I wonder if you just think back across some of the brands you've worked with, like what's an example of a campaign that really connected? What was the insight that was being discussed at that time about the consumer, what you were trying to accomplish that ultimately proved correct?
Sure. I'll use a high example and a low example. So when we launched Ugly Sparkling Water, it's a small British brand, here in the US last year, the tactic we used was basically an insult that if you were drinking anything other than ugly, you were a total basic bitch. And that you wanted it on your doorstep and you wanted it British, and you were completely uncool if you didn't. And it helped jumpstart their business. And that was a very small campaign that was mostly PR and influencer driven. I think that, when I look at the efficacy of campaigns, unless you're operating with, I'm going to go with like a $30 million ad spend, it's very, very hard, and spending it for like 2 years, it's hard to resonate unless that ad campaign is really deeply clever. So I think I look at another on a large scale level. We had a small ad buy with Rihanna at Vita Coco that ended up seeming much bigger because of the PR layer. So that was only really a regional ad buy, but if you look at the archives and the press on that, it made it look like it was a national campaign running everywhere. So that for me is a win because it didn't cost the brand a lot of money, but it had a lot of pull on a cool factor for a brand, right? And there are certainly ad campaigns running now. Dinah's running one with Health Aid right now, which is running nationally, and it's helping change the conversation of kombucha. But it's still in the nascent stages, so we look at, I think we'd have to look at it at 6 months and say, was it deeply effective? But that's kind of the magic of long-term campaigns, is because you can connect more deeply the longer you run them. So for brands that are running like a 2-month campaign, you're not going to get that much traction.
Well, so we are out of time, but the good news is there is a part 2 to this panel that's coming right up. Arthur is going to tap out, and Mike Bergmeyer from Whipstitch Capital is going to tap in.
Hey, it's Ray Latif with Taste Radio. If you like what you just saw, hit subscribe and ding the bell. You'll be happy you did.